I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements are my opinions. Investing involves risk. Always do your own research.
Hey, it's Crypto Frank, and I'm here to announce that Miller Momentum is now a crypto channel. We're going to talk about how to buy low and sell high and ride that volatility wave to make massive generational wealth on Bitcoin. Welcome back to Miller Momentum. Today we're going to talk about the recent Bitcoin crash and what caused it, and also why people continue to buy Bitcoin. So why is Bitcoin falling again? Well, the crypto cheerleaders will tell you this is just a healthy correction, a buying opportunity, a temporary dip in an endless up-only journey. We're not going to do that here. On this channel, I'm going to explain what's actually happening behind the scenes using real economic theory and not just referencing vibes. So let's get into it. Bitcoin hit its all-time high of around $126,000 back in October. As of this week, it's trading somewhere around $66,000, maybe down to $63,000. I haven't looked in the past few hours. But that's roughly a 48 to 50% decline in under 8 months. So if you bought one Bitcoin at the peak, you've lost about $60,000. That's a decent car, or a year of college at a prestigious university, or, a lot of avocado toast. Now I want to stress something that the crypto community often glosses over. This is actually not unusual for Bitcoin. It fell more than 80% in 2018. It fell 85% in 2014. Every single time it's recovered and gone to new heights, which is why the faithful keep buying the dip. But here's what academic finance has to say about that reasoning. Past price behavior is not a reliable predictor of future prices. We'll come back to that later. But for now, let's look at what's actually causing this particular crash. The first and biggest reason Bitcoin is falling is the macroeconomic environment right now, specifically what's happening with interest rates. Here's the basic economic logic. When U.S. Treasury bonds, which are about as close to risk-free as an investment gets, are paying you close to 5% a year, rational investors ask themselves, why would I hold something with no yield, enormous volatility, and no underlying cash flows when I can just own government bonds and collect 5%? This week, the Fed signaled that the rate cuts everyone was expecting later this year are probably not happening until 2027. The 10-year Treasury yield climbed to 4.82%, and almost immediately, institutional investors pulled $3.4 billion out of Bitcoin ETFs in a single week. And that's the largest single week outflow since those products launched back in 2024. This is not irrational behavior. This is textbook portfolio management. When the opportunity cost of holding a non-yielding asset goes up, you hold less of it. Bitcoin isn't special here. Gold, growth stocks, and other non-yielding assets all feel this same pressure when rates rise. At least most of the time they do. The difference is that Bitcoin is also extremely volatile and has no fundamental anchor, no earnings, no assets, no dividend, which makes the risk-adjusted case even weaker in a high-rate environment. The second cluster of reasons has to do with institutional behavior and a few headline events that spook the market. Let's start with Strategy, the company formerly known as MicroStrategy. Michael Saylor has built his entire public identity around never selling Bitcoin. He's the guy who keeps buying more no matter what. So when it came out that Strategy had sold 32 Bitcoin, a relatively tiny amount worth about $2.5 million, the market treated it like a betrayal, not because of the quantity, but because of what it signaled. If even the true believers are selling, who's left to hold the price up? Then there's the ETF profit taking. Many institutions entered Bitcoin positions in early 2026 around the $52,000 to $58,000 level. By the time rates started rising and macro conditions shifted, they were sitting on substantial unrealized gains. Selling into strength when conditions change is not panic, it's rational portfolio management. We also have the Mt. Gox situation. This is an old wound that keeps reopening. Mt. Gox was the world's largest Bitcoin exchange back in 2014. It collapsed after a massive hack. The bankruptcy trustee has been sitting on a large pile of Bitcoin ever since, slowly distributing it to creditors. Every time those wallets move, the market panics about a supply flood. This week, nearly $740 million worth of Bitcoin moved. The coins didn't actually hit exchanges, but the fear is real. And finally, AI stocks. Analysts are noticing that capital is rotating out of Bitcoin and into AI-related equities. The two are competing for the same pool of growth-hungry institutional money, and right now, AI is winning. The third reason the crash was so sharp, falling not just 5%, but 10 to 15% in 72 hours, is leverage. And this is where crypto really differs from traditional markets. In regulated stock markets, leverage is constrained. You can typically borrow up to twice your capital. In crypto markets, it's common to see traders borrowing 10, 20, even 100 times their investment. This is legal. It is also, from an economic risk management perspective, absolutely wild. Here's how liquidation cascade works. The price drops a little. That's enough to wipe out some highly leveraged long positions, meaning people who borrowed money to bet the price would go up. When those positions get wiped out, exchanges automatically sell the Bitcoin to recover the loan. That selling pushes the price down a little more, which wipes out the next batch of leveraged positions, which triggers more automatic selling, and so on. This week, over $1.23 billion in crypto positions were liquidated in a single day. The crash wasn't just driven by people deciding to sell. It was partly driven by automatic, mechanical selling triggered by falling prices. This is a structural feature of cryptocurrency markets and not a bug or something that's not supposed to happen. And it's one reason why Bitcoin drops tend to be faster and sharper than equivalent drops in, say, stock markets. The leverage amplifies everything. At this point, let's step back and ask a question, a very uncomfortable question, that most Bitcoin content on YouTube refuses to ask. What is Bitcoin, actually? Not in a philosophical sense, in a financial sense. From a traditional finance perspective, Bitcoin is a speculative asset. That means its price is determined entirely by what other people are willing to pay for it. It has no earnings, it pays no dividends or interest, it is not backed by any government, any commodity, or any institution. It has no balance sheet. You cannot analyze it using a discounted cash flow analysis or price to earnings ratios or any of that, all of the tools that work for stocks, because there are no cash flows. There are no earnings. This matters because it means Bitcoin's price is, in the technical sense, indeterminate. It could be worth $10. It could be worth $200,000. It could be worth zero. There is no underlying fundamental value to anchor it. Its price is a function of collective belief and demand. And collective belief can be very durable, or it can evaporate in an instant. Now, Bitcoin supporters will say that gold is the same. Gold doesn't have earnings either, and it's been valuable for thousands of years. That's a fair point, and we'll address it more in a moment. But gold has 5,000 years of track record as a store of value across every civilization on Earth. It also does actually have some utility. Bitcoin has 17 years of history at most. So what happens next? What happens after this current crash? To be honest with you, nobody knows. And anyone who tells you they do know for sure is selling something. What we can say is that Bitcoin's price is going to keep bouncing around. And there are several specific catalysts that will drive that volatility in the coming months. The Mt. Gox deadline is in October 2026. Creditors who have been waiting 12 years to recover their money are going to receive their Bitcoin back. Many of them are going to sell it. How many and how fast is uncertain. But every large wallet movement between now and then is going to trigger market reactions. The ETF flows are now a major price driver in both directions. The same institutions that pulled $3.4 billion out last week could put $3 billion back in. if the Fed signals a rate cut. This is new for Bitcoin. It used to be driven primarily by retail speculation. Now, institutional mechanics are layered on top of that. It means faster and larger price swings. Then there's the broader macro environment, inflation data, Federal Reserve decisions, and geopolitical tensions, including the ongoing US Iran situation. None of these are Bitcoin specific, but Bitcoin has become sensitive to all of them thanks to its institutional adoption. It increasingly trades like a leveraged risk asset, meaning it rises faster than stocks in good times and falls faster in bad times. And the leverage is still there. The structural features that created this cascade haven't changed. The next big price move, in either direction, will be amplified. Let's talk about what academic economics and finance actually have to say about Bitcoin, because this is the part that a lot of people skip. And the first concept is the greater fool theory. This is the idea that it's rational to pay an inflated price for an asset if you believe a quote unquote greater fool will come along and pay even more. This can work for a very long time, and it has with Bitcoin. It's worked with other assets too throughout history, including tulips, and it has made a few people insanely rich. But it only works as long as there's always a next buyer. When the pool of greater fools runs dry, the price collapses to whatever the underlying fundamental value is. For Bitcoin, that fundamental is, by conventional financial theory, indeterminate. It could be zero. The second concept is the efficient market hypothesis. In semi-strong form, this theory says that asset prices already reflect all publicly available information. What this means in practice is that if everyone knows Bitcoin tends to recover after crashes, that knowledge is already priced in. You can't reliably beat the market by following patterns or using public data after a certain point. This is why the just buy the dip advice is less compelling than it sounds. Maybe it works when Bitcoin is a small niche asset, but once it gets big, that logic starts falling apart. The third concept is no arbitrage pricing. For stocks and bonds, we can derive a theoretical fair value based on expected future cash flows. There's a price floor below which a rational person would just buy the asset and collect those cash flows. Bitcoin has no cash flows. And there is no analytical floor. The price could be $1. The price could be 1 million. Both are consistent with the theory. None of this means that Bitcoin will go to zero tomorrow, of course. It just means there is no rigorous analytical basis for saying that it won't. That all being said, I want to steelman the bull case here because intellectual honesty requires it. And frankly, dismissing Bitcoin entirely without engaging its best arguments is lazy. The strongest argument for Bitcoin is network effects. Every time Bitcoin has crashed, and it has crashed badly, repeatedly, it has come back and gone higher. That's not nothing. That's 17 years of surviving its own obituary. The number of wallets, institutional holders, and integrated financial products has grown through every crash. Network value can be self-reinforcing in a way that's genuinely hard to dismiss. The fixed supply argument is also legitimate. Bitcoin has a hard cap of 21 million coins. No central authority can change that. Although I suppose the committee that governs Bitcoin could update that code, but that's another matter. In a world where governments are running large deficits and expanding the money supply, a genuinely scarce asset has real theoretical appeal. This is the same logic that drives gold demand. The ETF argument is newer and more interesting than it sounds. The launch of Bitcoin spot ETFs in 2024 was a structural change, not just a narrative one. It opened the asset to pension funds, wealth managers, and institutional allocators who previously couldn't touch it. That's a new and potentially large pool of demand that didn't exist in previous cycles. And the gold comparison is worth taking seriously. Gold has no earnings, no dividends, no intrinsic value derivable from fundamentals, and its utility It's variable. It's used in electronics, it's used in dentistry, so I guess it does have some value above zero, but its value largely rests on a collective belief maintained over 5,000 years, an arbitrary decision to use it as a monetary technology. Bitcoin bulls argue they're building the same thing, just faster for a digital world. These are real arguments. I hold them at arm's length because 17 years is not 5,000 years, but they do deserve to be heard and considered. So let's bring it all together and recap. Why is Bitcoin falling? Several forces converged at once. The Federal Reserve signaled that rate cuts are farther away than expected, making Bitcoin less attractive relative to risk free yields. Institutions that bought in early 2026 had good reasons to take profits. Mt. Gox is moving coins, and the creditor deadline is approaching. A liquidation cascade amplified what might have been an orderly decline into a sharp crash, and capital is rotating toward AI stocks. Will it keep falling? I genuinely don't know, and neither does anyone else. There are real forces that could reverse this. If the Feds change its tone, if ETF flows flip, if macro conditions improve, short-term bounces are very likely. The structural volatility in this market guarantees it, but the forces driving it down are real and they don't disappear overnight. Will Bitcoin ever go to zero? This is the question that makes Bitcoin holders grumpy. But from the perspective of academic financial theory, the honest answer is we can't rule it out. There is no fundamental floor. The bull case is real, but it is unproven over the kind of timescale that lets us call anything a reliable store of value. So here's my actual advice. As someone who follows the academic economics literature on this, if you own Bitcoin, understand what you own. It is a speculative asset. Its price can go up a lot. It can also go to zero. Those are not equivalent risks to a government bond. Treat it that way when sizing your position. Don't invest more than you are genuinely willing to lose and lose completely. Now, let's get into my actual position on Bitcoin and crypto in general. The bear case. And this is just my perspective, my considered educated opinion. And I want to be direct with you. I think Bitcoin will actually and eventually and inevitably go to zero. Not tomorrow, not necessarily this year, but I believe it is structurally flawed in ways that will ultimately matter. Let me make the argument in three parts. First, energy. Bitcoin's proof-of-work mining mechanism consumes electricity at a scale that rivals entire countries. We are talking about energy consumption comparable to Argentina or Norway, just to run a payment network that processes a few 100,000 transactions per day. For context, Visa processes tens of millions. Here's the thing that the clean energy mining crowd misses. This is not a bug that can be patched. The energy expenditure is the security model. The whole point of proof of work is that attacking the network is prohibitively expensive because it requires prohibitively expensive computation, which requires prohibitively expensive electricity. Remove the energy cost and you remove the security. And it gets worse as the price rises. Higher Bitcoin prices mean more mining, more revenue, etc. More mining revenue attracts more miners. More miners consume more electricity. The system is designed to scale its own resource consumption in lockstep with its own market cap. Now you might say, who cares if people value it enough to pay for it? That is a fair question. But here is the economic framing. Bitcoin is essentially paying a permanent, escalating maintenance tax just to maintain its current value. Its utility bill is going up and up and up and up, and that tax is real. It is paid in electricity and hardware. For that to make sense, the utility Bitcoin provides has to justify the cost. And that brings us to part two. Bitcoin doesn't do what it was supposed to do. Bitcoin had two main identities over its 17-year life. The first was as a currency. a peer-to-peer electronic cash system, as Satoshi Nakamoto literally described it in the 2008 white paper. The second was as a crisis hedge, or digital gold, a refuge from inflation and financial instability. It has failed pretty convincingly at both. As a currency, Bitcoin processes around 7 transactions per second. Visa handles around 24,000. During periods of network congestion, Bitcoin transaction fees have spiked to $50 or more, making it useless for small purchases. El Salvador made Bitcoin legal tender in 2021, and its adoption by ordinary Salvadorans has been minimal. Almost nobody uses Bitcoin to actually buy things. The people who hold it are treating it as a speculative asset, not money. That's not what it was designed to be. You can call that an evolution, but it's not what was advertised. As a crisis hedge, this is where the record gets genuinely damning. When COVID hit in March 2020, Bitcoin crashed 50% in 48 hours, alongside stocks. When the Federal Reserve started raising rates in 2022 to fight inflation, exactly the scenario where a store of value should shine, Bitcoin fell 75%, moving in lockstep with growth stocks. When geopolitical tensions escalated in 2025, Bitcoin fell with risk assets again. In all of these events, gold did what a crisis hedge is supposed to do. It held its value or went up. Bitcoin doesn't trade like digital gold. It just doesn't. It trades like a highly leveraged tech stock. That's not a hedge. That's the thing you're supposed to hedge against. Part 3 of my argument for the bear case, and this is the one I find most interesting, the story broke. Bitcoin was born in the wreckage of the 2008 financial crisis. The very first block ever mined, the Genesis block, contained an embedded message, a newspaper headline about the British government bailing out banks. It was a deliberate statement. Bitcoin was designed to be an alternative to a financial system that had failed the public and bailed out the people responsible. It was anti-bank, anti-state, anti-institutional trust. The entire technical architecture, decentralized, anonymous, trustless, was built around that philosophy. The story was compelling, and for a while it held together. Then something interesting happened. Bitcoin got valuable, and the moment it got valuable, the institutions it was built to replace started buying it. BlackRock now has a Bitcoin ETF. So does Fidelity. So does Vanguard, I think. I think they just launched one, which is shocking to me. But the largest asset managers in the history of human finance are now in the Bitcoin business. The White House has discussed a strategic Bitcoin reserve. The US government, which Bitcoin was explicitly designed to route around, is now one of its principal institutional supporters. Think about what this means. Bitcoin's price is now heavily dependent on institutional inflows. If BlackRock pulls its ETF or the government changes its regulatory posture, the price collapses. The asset that was supposed to be independent of institutions is now structurally dependent on them. The libertarian origin story has been thoroughly inverted. You can argue that this represents Bitcoin winning, going mainstream, achieving legitimacy, but I would argue it represents Bitcoin losing the one thing that made it philosophically coherent. What you have left is a speculative asset with a very high energy cost, no fundamental value floor, no proven utility, and a price that depends on the goodwill of the institutions it was designed to replace. That, to me, is a fragile foundation indeed, and fragile foundations tend to crack catastrophically. To me, the bear case is more than compelling, it's nigh conclusive, to me, at least. But let's change gears for a moment. We've made the case for why Bitcoin may be in serious trouble, structurally and philosophically. But here's the question that we really need to consider. If that's all true, why do so many smart people keep buying it? Why do people who've lost 50%, 60%, 70% of their investments continue to hold? Why does every crash generate a new wave of buy the dip enthusiasm rather than rethinking? The answer is not that these people are stupid. The answer is that they are human. And human psychology is exquisitely poorly designed for navigating speculative asset markets. What follows is not a judgment on anyone, it is a description. These are documented, peer reviewed cognitive patterns that affect almost everyone, including, almost certainly, you and me in other contexts. Understanding them is the most useful thing I can offer you today. Let's start with two of the most fundamental and most studied patterns in behavioral economics. The sunk cost fallacy is the tendency to continue investing in something because of what you've already put in, not because of its future prospects. In ordinary life, you see this everywhere. You eat a meal you're not enjoying because you paid for it. You stay in a movie that's bad because you've already been there an hour. You hold a stock that's falling because you can't stand to book the loss. In Bitcoin, it sounds like this: I bought at $90,000. I can't sell at $66,000. I'll wait until it gets back to what I paid. This feels rational. It's not. The market has no memory of what you paid. The rational question is, given today's price and today's information, should I own this asset? Not, how do I recover my cost basis? The sunk cost fallacy makes the second question feel like the first one. It isn't. Loss aversion is related but distinct. Kahneman and Tversky demonstrated in their Nobel Prize winning work on prospect theory that humans feel losses roughly twice as intensely as equivalent gains. So losing $1,000 produces about twice the psychological pain of winning $1,000. This asymmetry has profound implications for investment behavior. For Bitcoin holders down 50%, realizing that loss, actually selling, means experiencing the full psychological weight of having lost half your money. Holding keeps that loss in the unrealized category. It's merely theoretical, not a real thing, which feels different. It's still a loss, though. It's just a loss you haven't admitted to yourself yet. The psychology doesn't know the difference, but it sure feels the difference. These two forces together create an extremely powerful holding bias, especially for volatile assets that have previously recovered. It came back before, it'll come back again, right? Maybe, but that's faith, not analysis. The next two psychological forces are related and compound each other. Confirmation bias is the well-documented tendency to seek out and believe information that confirms what we already think, and to discount or explain away information that challenges it. This is not a character flaw. It is a feature of human cognition that researchers have found in virtually everyone across all domains. You cannot get rid of it in yourself. In Bitcoin, this plays out through the communities that form around it. Reddit, X, Discord, YouTube, Bitcoin content ecosystems that are heavily tilted bullish because bullish content gets engagement. The algorithm rewards optimism. Critical analysis gets dismissed. The person who bought at $90,000 is now embedded in a social media environment that tells them constantly that they were right. The fundamentals are unchanged, and anyone who disagrees simply doesn't understand. Every crash becomes a shakeout of weak hands. Every critic is a no-coiner who will regret it. The feedback loop is closed. Then there is the identity trap, and this one is particularly powerful. For many Bitcoin holders, especially those who have been in it for years, Bitcoin is not an investment in the way that owning a stock is. It is a statement about the banking system, about government overreach, about being smart enough to see something before everyone else. Bitcoiner is a genuine identity category, complete with its own culture, vocabulary, and social norms. When an asset becomes part of your identity, selling it is not merely a financial decision. It can be an act of self-betrayal. It means admitting you were wrong about something much bigger than a trade. So, people don't sell. They reframe the loss. Diamond hands, long-term vision, the weak are being shaken out, catastrophic losses get turned into moral virtues. It's a remarkable psychological adaptation, and it keeps people in positions they should have exited a long time ago. I'm going to give you the full playbook of how losses get rationalized in speculative markets. None of these are unique to Bitcoin. You can find all of them in the tulip mania of 1637, the dot-com bubble of 1999, and the US housing market in 2006. Human psychology doesn't update much across centuries. So, the narrative fallacy. Humans are story processing people, not probability calculators. Bitcoin is the future of money is a story. Digital gold is a story. Stories survive disconfirming evidence because they can always be extended. The story isn't over yet. Every crash becomes a chapter in the comeback narrative rather than evidence against the thesis. Then you've got social proof and FOMO. Financial markets make winners extremely visible and losers extremely quiet. During every Bitcoin rally, the people who got rich are all over social media. The people who lost money are mostly silent. This visibility asymmetry produces a systematically distorted picture of how common success is. And when everyone around you seems to be winning, not participating feels like the irrational choice, even when it isn't. And then you have intermittent reinforcement. This is the slot machine mechanism. Bitcoin has recovered dramatically from previous crashes. 3 times, 4 times, 5 times. Variable ratio reward schedules produce the most persistent behaviors in humans and animals. The previous recoveries are extremely powerful psychological evidence that another recovery is coming. The fact that the past price is not predictive of future price doesn't feel true after watching something go from $100 to $126,000. Reframing the loss is the linguistic layer. I'm not down, I'm accumulating at a discount, or only weak hands sell at the bottom. This is a test of conviction. These phrases convert a financial fact, you are currently poorer than you were, into a moral narrative in which holding is a virtue and selling is a failure. Escalation of commitment and the macro excuse round out the set. Once you're in deep, it becomes very hard to exit, and there will always be a macro reason for the crash that can be used to separate the asset from its performance. Understanding these patterns won't make you immune to them, but it might make you pause the next time you find yourself saying this is just a shakeout after losing 40% of your money. After all, we can't totally eliminate these behaviors from ourselves, but we can minimize and control them and learn to recognize them over time. Here's the full picture. First, my position stated directly. I believe Bitcoin will eventually go to zero. I want to be careful with that statement because eventually is doing a lot of work. I am not predicting a crash next month or next year. I am making a structural argument. The energy costs are real. They are large and they scale with price. Bitcoin has not become a currency. It has not become a crisis hedge. Its price is now structurally dependent on the very institutional support of the very system it was designed to replace. And the philosophical foundation that made it compelling, the anti-establishment, anti-institutional narrative, has been thoroughly hollowed out. These are not cyclical problems. They are not things that a better macro environment fixes. They are features of what Bitcoin is. And yet, the psychology we just described is not going away. Communities of true believers are durable. Intermittent reinforcement is powerful. The next rally will bring the next wave of buyers. Bitcoin could go from $66,000 to $200,000 before it goes to zero. Or it could just die this year, who knows? I wouldn't bet against a short-term recovery though, because the forces driving short-term price action don't care about structural arguments. Here's the question I want to leave you with though, and I would encourage you to sit with it honestly. If you hold Bitcoin, what would have to be true for you to sell? Not what price would it have to reach? That's still the sunk cost frame. What evidence would change your mind about whether Bitcoin is a good investment? If you can't answer that question with something specific and testable, you're not investing. You're hoping. Hoping is fine. Plenty of people have gotten rich on hope in crypto. But hope is not a strategy, and it is not analysis. And unfortunately, it will let you down more often than not. Know which one you're doing, hoping or investing. Thank you for watching Miller Momentum. I hope you enjoyed today's video. Who knows, Crypto Frank may make another visit, especially if crypto does something interesting again, which it almost certainly will. Don't forget to like and subscribe and leave a comment. I'd love to hear your opinion on crypto and your experience with it. Good, bad, somewhere in between.